Welcome to the long game. I'm Nathan Carter, and just so you know, this voice is AI generated, but every word is written to give you real insight with clarity and care. Today, we're diving into a subject that has quietly made more fortunes than a lottery wins and lucky breaks combined. It's not flashy, it's not fast, but it works. And it works in a way that can change your life if you understand it deeply. We're talking about value investing. At first glance, that phrase might sound plain, almost too quiet for the noisy world of finance. But underneath its simplicity lies a powerful truth. The most reliable way to build wealth isn't by chasing trends or jumping in and out of markets. It's by learning how to truly recognize what something is worth, and then patiently waiting until the world catches up. Imagine for a moment that you're walking through an old neighborhood. The houses are modest, the sidewalks are cracked, some front yards are overgrown. But then one house catches your eye. The paint is fading, the porch is creaky, but something feels different. You walk inside and you notice thick oak beams that haven't rotted. The foundation is rock solid. The layout is classic, efficient, and full of charm. Maybe no one else sees it, but you do. And you know, if someone gives this house a little care, a little time, it could be worth far more than its current price. That, in essence, is value investing. It's the art of seeing something real beneath the noise, something solid, durable, and underappreciated. It's not about gambling on the next hot stock. It's not about timing the market or watching every flicker on a stock ticker. It's about understanding businesses, understanding people, and understanding time. Let's take a moment to talk about one of the most famous investors who ever lived, Warren Buffett. You've probably heard the name before. What many people don't realize is that his success isn't built on flashy trades or secret formulas. It's built on a mindset, the mindset of a value investor. Buffett once said, "Price is what you pay. Value is what you get." Think about that for a moment. In our everyday lives, we intuitively understand this. You can go to a market and buy a beautifully packaged bottle of water for $3. But just a few feet away, there might be a cooler with the exact same water, without the fancy branding, for just $1. Same water, different price. The value hasn't changed. Only the perception of it has. In the world of investing, it's the same. Stocks, which are just slices of real businesses, get priced every day by millions of opinions, emotions, guesses, and assumptions. But beneath all that noise is something far more stable, the actual value of the business itself. Let's look at Apple. Today, it's one of the most valuable companies in the world. But there was a time, not too long ago, when many investors thought Apple was finished. Back in the late 1990s, Apple was struggling. Its products were seen as outdated, its market share was shrinking. People were calling it a dying brand. But if you looked closely, if you really paid attention, you could see something others didn't. You could see its loyal fan base, its culture of innovation, its deep connection to creativity and design. And if you had invested in Apple back then, not because it was popular, but because it was undervalued, you would have made an extraordinary return. That's what value investing is all about. But here's the catch. Value investing isn't easy. It's simple, yes, but not easy. It takes discipline. It takes patience. And most of all, it takes a willingness to think independently. When the crowd is running one way, the value investor often walks the other. When panic hits the market and everyone's selling, the value investor is calmly watching, quietly asking, has the real value of this company changed, or is this just fear? Let's take another example. Microsoft. In the early 2000s, after the dot-com crash, Microsoft was seen as a dinosaur. It was still making money, lots of it, but the market had moved on. Tech darlings like Google and Facebook were rising. Microsoft was old news. But beneath the surface, Microsoft was still a cash machine. It had dominant software products, it had a strong balance sheet, it had massive scale. If you had looked at the numbers, the business was healthy, even though the stock price was dragging. Over the next decade, Microsoft quietly reinvented itself. It moved into cloud computing, it improved its product design, it rebuilt its reputation, and its stock price followed. But the value had been there long before the headlines noticed. That's the beauty of this approach. Value investing is like planting seeds. Not all of them grow overnight. Some take years. But if you plant the right seeds in fertile soil and give them time, they grow into something far more powerful than any quick trade. This mindset also protects you from making emotional mistakes. In a world where people often buy high and sell low, driven by fear and greed, the value investor stays grounded. You're not buying hype, you're buying real businesses. Think of it this way. Imagine you're buying a farm. You don't care what the market says it's worth every day. You care about the crops it produces, the strength of the soil, the consistency of the rainfall, the reliability of the farmer. Stocks are the same. They're not just blinking lights on a screen. They're businesses with customers, employees, products, and most importantly, futures. If you understand the story behind the business, if you understand what it's really worth, you're no longer playing a guessing game. You're making informed decisions. You're investing, not speculating. In part 2 of this episode, we'll go even deeper. We'll explore how to evaluate value, how to spot good businesses even when they're out of favor. We'll talk about what to look for in a company's leadership, and we'll cover some of the biggest mistakes new investors make and how to avoid them. But for now, I'll leave you with this thought. In a world full of noise, value investing teaches you how to listen. In a world chasing speed, it teaches you patience. And in a world obsessed with price, it teaches you to look for true worth. Thank you for joining me today on The Long Game. I'm Nathan Carter. I'll see you in part 2. Welcome back to The Long Game. I'm Nathan Carter, and as always, this voice is AI generated, but every word is crafted with care to bring you clarity and insight. In our last episode, we explored what value investing truly means, not as a strategy of quick wins, but as a deep mindset, a way of seeing. Today, we're going even deeper. We'll talk about how to recognize true value in a company, even when the market doesn't. We'll look at what makes a business truly strong beneath the surface, and we'll see how great investors make decisions, not just with numbers, but with wisdom. Let's begin with a simple idea. Not all businesses are created equal. Think about 2 restaurants. One is always packed, rain or shine. People travel across town just to eat there. The staff is friendly, the food is consistent, the owner knows every detail, from the suppliers to the spice mix in every dish. Now picture the second one. It opened recently with a big launch, flashy signs, social media buzz, but the food is hit or miss, the service is clumsy, Reviews start dropping. A few months later, the crowds thin out. On the surface, they might seem similar. Both serve food, both charge customers. But if you're an investor, you're not just looking at the current popularity. You're asking, which one has staying power? Which one can thrive for years, not just weeks? That's exactly how value investors look at companies. Let's take Amazon as an example. When Amazon started, it was a tiny online bookstore. It wasn't making much profit. In fact, it lost money for years. But if you'd looked closer, you would have seen something different. You'd see a company building a massive infrastructure, warehouses, logistics, customer data, and most of all, trust. You'd see a founder, Jeff Bezos, who wasn't focused on short-term earnings, but on long-term market dominance. Amazon wasn't priced like a value stock, but in hindsight, it was an incredible value, because its true worth was far greater than what most people could see. So, how do you, as an investor, spot something like that? It starts with understanding the business model. Ask yourself, how does this company make money? Is its revenue steady or seasonal? Do customers come back again and again, or do they try it once and move on? Now think of Microsoft's Office software, Word, Excel, PowerPoint. People use it daily in schools, businesses, governments, and more importantly, they pay for it every year, now through subscriptions. That's what we call recurring revenue. It's like owning an orchard that produces fruit every season, not just once. Contrast that with a company that sells expensive furniture. It might make a lot of money when someone redecorates their home, but that same customer may not come back for another 10 years. Recurring revenue is one sign of deep value, but it's not the only one. Another key is a competitive advantage. Buffett calls this an economic moat, like a river around a castle, something that keeps competitors from stealing your customers. For Apple, the moat is brand loyalty. For Google, it's search dominance and ad targeting. For Costco, it's scale and price. It can offer lower prices because it buys in such huge quantities. As a value investor, you're constantly asking what makes this business hard to copy. Because the harder it is to copy, the more likely it will survive and thrive over time. But there's a danger here too. Some companies look strong until the world changes. Take Kodak. It once owned the photography industry, but it failed to adapt to digital. Its moat crumbled. Meanwhile, companies like Netflix saw the shift from DVDs to streaming and leaned into the change. That's why value investing isn't just about numbers. It's about seeing the full picture. A company may be cheap for a reason. Maybe its industry is dying. Maybe its leadership is failing. Maybe the world just doesn't need what it's selling anymore. That brings us to something critical: management. When you buy a stock, you're not just buying a product, you're partnering with people, the people who run the business. You want to know, are they honest? Are they disciplined? Do they treat shareholders with respect? Warren Buffett often says he looks for managers who are able, honest, and aligned with shareholders. That's a powerful trio. Look at Tim Cook at Apple. He didn't try to be Steve Jobs. He leaned into his own strengths: supply chain mastery, operational discipline. Under his leadership, Apple has grown even more stable and profitable. Look at Satya Nadella at Microsoft. He shifted the company's mindset from control to collaboration, opening up to other platforms, embracing cloud, rebuilding culture. Good management doesn't just steer the ship, it sets the course, avoids icebergs, and finds new oceans. Now, let's talk about patience. This is maybe the hardest part of value investing, because in our world today, patience is almost a superpower. Everyone wants fast results, but great businesses don't reveal themselves overnight. The market doesn't always see value immediately, and sometimes your investment might sit still while everyone else is racing ahead. That's when doubt creeps in. That's when people start to sell. But value investing says, Don't just stare at the stock price. Watch the business. Is it growing? Is it profitable? Is it building something? If yes, stay calm, stay invested. Let time do the heavy lifting. Think of it like planting bamboo. For the first few years, you may see almost nothing, but underground, the roots are spreading, strengthening. And then, suddenly, it shoots up, fast and strong. That's what compounding looks like. Quiet at first, explosive later. And now a quick word on mistakes. Every investor makes them, but value investing gives you tools to make fewer. One big mistake, falling in love with a cheap stock. Just because something is cheap doesn't mean it's valuable. A broken car might be cheap, but if the engine is missing, the tires are flat, and no one knows how to fix it, it's not a good deal. Another mistake, overconfidence. Thinking you found a hidden gem and putting all your money into it. But even great investors are wrong sometimes. That's why diversification matters. Think of your investments like a garden. Some plants will flourish, some might fail, but if you choose wisely and tend it with care, the whole garden grows. And finally, the most dangerous mistake is forgetting your why. Value investing isn't about winning the next quarter. It's about building a foundation for your family, your future, your freedom. It's slow, it's thoughtful, it's deliberate. But in a world chasing speed, those who can slow down and see clearly will always have the advantage. So, where do you begin? You don't need to be a genius. You don't need to time the market. You just need to start asking better questions. What does this company really do? How do they make money? Do they have loyal customers? Do they have a future? And is the current price offering me a margin of safety? Because when you buy with a margin of safety, you're not just betting on growth. You're protecting yourself if things go wrong. It's like buying a house for less than it's worth. Even if the market slows down, you still got a good deal. That's the heart of it all. Value investing is simple, but not easy. It's about thinking like a business owner, not a gambler. It's about seeing clearly, waiting patiently, and acting decisively. And most of all, it's about trusting that time is your ally, not your enemy. Thank you for joining me on The Long Game. I'm Nathan Carter. I hope today's episode gave you a deeper way to think, not just about stocks, but about how to approach decisions in life. And remember, it's not about what happens next week, it's about what holds true over decades. That's the long game. Until next time.